What's going on, everybody? Good morning. Can everybody hear me? What is going on? Let me do a couple things on Twitter. Let's go. Let's go. Yo. Good morning. Good morning, everybody. All right, let's see what's going on. Yo, what's up? Okay, we are live. What's up, guys? Good morning. Yo. Oh my god, you guys are ready to go. We are ready to go. All right. Sorry guys, I forget like the live stream. It always takes me a minute to get everything ready. All right. Here we go. What's going on, everybody? All right. Let's do it. We have 17 minutes till the earnings. Now, if you watched my video yesterday, and be sure to share this video on Stock Twits and Twitter. Just share the video everywhere so we get more people joining. Smash the like button if there is one. Drop a comment and let's get it. Here we go. Let's just try and get up to 1,000 people before the earnings come out. Here we go. There it is. This guy's smart. This guy is really smart. Smart. Oh, I don't blame you. Hey, I don't blame you, man. I can't blame you here. Let's go. So I did tell you guys. I mean, I think today is a pretty good day to report. I know a lot of people are saying the world is ending, but I think today's a good report. I just think it's crypto. Uh, crypto's falling out of the world right now. Let's see. Bitcoin. Here we go. Yeah, Bitcoin right now 82K. I think Bitcoin is a big reason why the market is just really getting hammered. If you look at like Ethereum, Solana, Mara Riot, MicroStrategy, I mean, all those stocks are just falling off a cliff because of crypto right now. But we just got a little bit of revenue coming in from crypto right now. It's not going to hurt us at all. So we're just taking part of this little beating right here. That's all good. We're gonna shine today. And of course, the new Fed chair. We're getting the announcement today from Donald Trump. So we're gonna get the new Fed chair today. All eyes are on us, guys. I'm telling you, there ain't nobody reporting today. Nobody's reporting today. This is a good day to report. Pretty dang good day to report, I believe. So I think crypto is just what's shaking up the markets. I think it's a good day to report. So yeah, see? Crypto, silver, gold. I think the Fed chair getting announced is a bullish day. It's a good day to report. Let's do it. Agreed. I will be trimming. Come on, guys. Here we go. 15 minutes. Smash the like button. 15 minutes. We got a little bit of time. Yep, that was the one. I made a video yesterday. I said one company's report, and I said Visa or MasterCard, American Express. So all eyes are on SoFi today. Okay. We need a blowout. And if Anthony Noto wants his PSUs, he has to do a blowout. If they don't guide hard today and guide real crazy, if they don't have a big guidance today, they won't get the PSUs, the 35s and the 45s. It just won't happen. They might get 35 by like the end of the year, but they're not getting the PSUs by June. If they do a soft guidance, it's not going to happen, guys. So it's up to management what they want to do. Let's go. Appreciate it. No, I'm not selling. Appreciate it. Good morning. Let's go, guys. We got 13 minutes. 13 minutes. This is it. This is what we've been waiting for. 13 minutes. It's up to management at this point, okay? Q4, I'm excited for Q4. I think we are going to hit 42% growth or more. That's not bad. 42% growth is not bad at all. It's just the guidance. It's up to management. Do they want their PSUs? Let's see what they want to do, man. They want to be conservative again. You'll be flat today. Flat, maybe red. Thank you, thank you, thank you. Any predictions? I can only really predict the guidance, and I'm just hoping for over 60 cents. Our low end is 55. Analysts want 55, just over 60, preferably over 65, and that should get us going because analysts want 55. So analysts want 55. Put in a 65 guy. We should be moving. Let's see where the $3.5 billion went to. Okay, if we see revenue growth up 50% without the Chime termination fee, then we know where the money went. It went to growth, marketing, market share for lending, mortgages, student loans. Let's see what the loan platform business did. Let's see if we get clarity on the 10 Galileo deals for Q1. I mean, come on, guys. The 10 Galileo deals, that's got to help for this year, 2026. It's got to help EPS. It's got to help everything. You got Trump on your side, giving you a shout out. I mean, you got a potential dovish Fed coming in with Trump's pick today. I don't know what time that is. Don't blow it with a soft guidance. Just don't blow it. It's going to come out, 7 a.m. You're going to get the number, 7 a.m. So we got 11 minutes, guys. Let's do this. Smash the like button. Let's get it. Let's get it. Share the video. Stock Twitch, Twitter, Reddit. Just share this video. Let's get it up. Let's get our numbers up. We're almost at 800. Let's pump it up a little bit. Yeah, 42% growth. It's my prediction. 42% growth. 1.05 billion. If we do come in over 1.1 billion, I'm gonna freaking freak out. If we come in over 1.1 billion, but I don't think it's gonna happen. But I think we're gonna hit 1.05 billion with this with these cross, our cross buy acceleration is kicking in. We got that cross buy picking up. Members are going up. People are using more products. I think 1.05 billion is gonna happen. Let's go. Let's go. Good morning. Yep. Trim. Can't do 3 dilutions in 6 months. Trim it. I don't blame you. 7 a.m. Eastern. Good morning. Oh yeah. I mean, SP 500 inclusions March. Yeah, so they might be able to hit the 35 PSU with the S&P 5, even if they soft guidance. So it's a possibility. Let's go. Yep. The difference between Robinhood and SoFi right now is EPS and margin. That's it. Robinhood's EPS margin has just taken off the past 5 quarters. SoFi's just been real slow. Members. Robinhood is already in max margin EPS. They just don't stop growing their EPS. True that. Let's see it. It's up to Noto. If he wants it, he's got to go and get it. There you go. If we get the 55, that's what analysts want. So that's the bottom end. We know that they'll probably come in at the end of the year, 70, something like that, 75. The problem is, you need something to offset this bad guidance because we've been ready for this for 3 years, 55 to 80. You need revenue growth over 32%, over 35, because analysts, they want 28% revenue growth. That's still pretty fast growth. So you got to be over 28% growth for the guidance if you're only going to guide 55 cents. So The good news is our expectations are pretty low. Okay, I put out a couple videos. Tanner Tevis, Roy put out a couple videos. Our expectations are pretty low for guidance. We think the Q4 is going to be insane, but we just know how SoFi operates, and everybody's scared about that EPS number. Maybe it comes in at 50 cents, but maybe if they explain something like, hey, 2027 and 2028, we're going to be at $1.20 and $1.60. Okay. It, they have a chance to, correct themselves, or not correct themselves, but justify themselves. If it is 50, 55, hey, 2028, $1.70, $1.80, that could rocket the stock up too if they put out a 2027, 2028 guidance. So they have a chance to, they have some wiggle room if they really want to go after growth this year. Insane growth. That's the reason why the EPS number this year will be low, 55, 50, so let's see what we got, guys. This is a big catalyst, guys. And if you look at my Twitter, I've been telling you, SoFi is number one financial service company market cap out of all 15. We're the number one eligible for market cap. Isn't that same? That's because we're the 14th, 13th largest bank in America right now. So yeah, we're number one eligible or for market cap out of all 15 companies. Total, we're like ninth market cap. So there's a chance we can get in if they put in a financial service company. SoFi's going in, so maybe 4 companies get in March. Chance right now, I don't know, 15%. It's got to be low. I mean, they just raised $4 billion. Let's see where this $4 billion goes. Ha ha ha. Let's go. All right, guys. Let's do this. Here we go, man. We're getting close. Here we go. I would say right now, crypto, big crash in crypto, big pullback, and also government shutdown. But we know what happened after the last government shutdown. We shut down for a month. The market rallied for one entire month. So you just got government shutdown and crypto. Those are the two big ones right now. I personally think, the new Fed getting announced today, that's bullish. And if you get a Fed dovish that's going to be cutting 3-4 times next year or this year, Jesus, that helps SoFi so much. So I think a new Fed chair is bullish once the announcement gets made. Yeah, just crypto and crypto and the government shutdown. That's really it. Let's go, guys. Yeah, 1.05 billion. Come on, guys. We got 5 minutes to go. 5 minutes to go. Let's push these numbers up. Come on. Let's just go for it. 1,500 is a big report. They might blow it out of the water. It's gonna be an exciting time. Yep. 42% growth. That's what I'm betting on. 5 minutes. 5 minutes. Good morning. Good morning. Good morning. 30. Yeah. Nah. 10%. I don't know. I have to look. Probably towards the end. Remember, growth be huge. Yeah. Let's do it. Let's do it. Solid. Here we go. I don't know if they made an announcement. Yep. 35 and 45. Good morning. I don't blame you. I don't blame you. Here we go. Yeah, it's gonna be nice. Yeah, we're going over $1 billion. We're going over $1 billion today, guys. We got it. We got it. Let's do it, Noto. Let's do it. No more sandbagging. Guys, we've been getting crushed the past 3 weeks. I got 12 out of 15 red days. We've been getting crushed. 4 minutes. 4 minutes. This is it, guys. This is it. Here we go. Here we go. Here we go. Big buys coming. Come on, baby. Come on, baby. Come on. Let's go. Okay, looks like it's in. Looks like it's in. Okay, new Fed. Let's go. Possibly, they buy a small AI company or something. It's possible. Here we go. Here we go. I'm ready. I'm ready. Come on, baby. Let's go. Slightly, a little bit. Tiny. I've been watching the moving averages. We're below like all of them right now. The 200 days like $22. Here we go. Let's go. Fed chairs announced. Yep, Kevin Warsh. Looks like it is official. Here we go. 3 minutes, guys. 3 minutes. Come on, baby. Come on. Come on. Come on. Y'all ready? Y'all ready? This is it. Love it. Love it. Love it. Like the video. Here we go. This is it. Let's see what's going on. I gotta get here we go. I got the presentation up. Okay. Got the presentation up. See if we can find this video. Okay, 3 minutes, guys. 3 minutes. The market wants to see big guidance. I mean, we really do think Q4 is going to be a blowout. Come on, everybody really believes there's going to be a Q4 blowout, right? I mean, everybody's predicting that at this point. Oh my God, if we hit 1.2 billion, it's over. Nuclear launch to planet Neptune, planet Mars. If it comes in at 1.2 billion, it's over. Honestly, if it comes in at 1.1 billion, we're going nuclear. I'm betting 1.05. I'm telling you, if that happens, anything over 1.1, it's going nuclear. Nobody might not even believe the guidance, to be honest with you. All right, guys, I'm going to the top. Here we go. Here we go. We got 2 minutes. I'm going to your top of your comments. So I'm reading the top of the comments right now. Let's go. Good morning. Let's go. What we got? High expectation Q4. Yep. 2026. Got 2 minutes. 2 minutes. 2 minutes. 2 minutes. Y'all ready? Y'all ready? Here we go. 1 minute. 1 minute. 1 minute. 1 minute. 1 minute. Here we go, guys. This is it. This is it. Here we go. Any second now. You know what I mean? Couple seconds. Here we go. Numbers are coming out. It's 6:59. 6:59. All I'm gonna really do is I'm gonna post the numbers on Twitter once I get the numbers, and I'm on Sofi's website. That's usually where I go first. I'm just updating it, and I sometimes go on the Stock Twits forum to see if that comes in early. Sometimes stock tightens pretty quick. Here we go, guys. This is it. It's about to be 7 any second now. The earnings are coming. Here we go. Good luck. Good luck, guys. Good luck. Good luck. 7 a.m. Here we go. Numbers are coming out. Hopefully, SoFi management knows what to do on that guidance. Hopefully, management knows what to do. I'm looking for 42% growth rate for Q4. Sometimes it takes me a minute and a half to get the numbers. I'm on the website. Forums up. Any second now, guys. Any second now. Any second. Any second. I usually trust stock tighten early. Here we go, guys. Here we go. Any second now. Any second. 7 o'clock. Come on, baby. Come on, baby. Give it to us. Give it to us. Any second. Any second. Any second. 7:01. 7:01. Numbers should be out right now. Numbers should be out right now. Numbers should be out. Some people probably got the numbers on like here we go. 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 We're almost there, guys. Any second, I'll have the numbers for you. Come on, Jesus. What's going on? Come on, baby. Come on, baby. Why is it taking so long? Come on. I should have them by now. $7:01. Come on. Come on. Come on. I'm on the website. I'm on the website. SoFi's website. I'm on SoFi's presentation. Come on, baby. What's going on? Some people got the numbers. Why is this? Come on, man. Where are we going? Where are we going? Where are we going? Some of you guys might have the numbers. Website is not updating for me. Come on, baby. What is going on? 1 second, guys. I see them popping up on on the forum a little bit, but I don't trust these numbers yet. I'm just waiting. Is anybody on the website right now? Is anybody on the website? Is anybody on the SoFi website? The SoFi website should have the numbers. They're not on. I'm on the website. Come on, baby. Yeah, stock Titan. Let's go. Come on. Yeah. I've never seen SoFi's website this late. What the hell is going on? What the heck? Yeah, this is the slowest I've ever got the numbers. Um. Hmm. One second. Everybody should see the numbers by now on the website. My I don't know if the website's frozen on SoFi. I just wanted to get the numbers from there. Jesus. It's like is anybody getting the website? Is everybody getting the website right? Like, does the website update? I just want to look at the website. SoFi's website, is it updated yet? Like, is it showing the Q4 report on their website? Yes or no? That's all I want to know. Because I'm still on it. That's SoFi's website. Is that doesn't update right now? Like, I know Tevis posted the numbers. 13 cents EPS. But it's like, why aren't they updated on the website? What? Like, what is it? Yeah, it's been 7 minutes. I seen the numbers. I just want to clarify the numbers before I post them. I like to get them from the website. They beat EPS, 13 cents EPS is what it's saying. 13 cents. Guidance was, or the expectations were 11 or 12. Come on, Sofi. What are you guys doing today? Post your damn presentation. The fuck? Why are they not having the presentation on their stupid stuff like this just makes me so mad. Why can't you guys just have your own website updated with your numbers at 7 a.m.? Like, I've seen the numbers on 4 different forums, but it's just like, it's just the easiest to read on their website. Come on, guys. Anybody got the website update, or is they're not doing an update on their website? I'm pretty pissed right now. I'm still on their. Yeah, numbers look solid. Is the website working yet? Anybody? Website. Here we go. Someone said it's there. Overview, update, events and presentation. Are you sure? That's crazy, bro. They must be trying to release something. They must be releasing something. Yeah. So it looks like we can't get the official numbers off SoFi's website. I'll just go on here. All right, guys. We got reports, quarter, net revenue of $1 billion. See, you're not getting the exact number. I've seen a ton of things saying it was like 1.013. Adjusted EBITDA, 300 million. Fee-based revenue, 440. Member growth, 13.7. I can't even post this because I'm not even going to post this because this isn't what I post online. It's just, it's 39 cents. Yeah, I can't read this. I got to read it on their website. This is crazy. No update on the website. Yeah, I can't even post it. It's if it's on the website, it's just so easy to read everything all at once. What you're looking at here is just like this is just doesn't really show you, like, it's hard. Come on, man. What is going on? All right, someone said update it. Why do some people say it's updated and then it's still not? Okay, boom. There it is. Jesus, thank the Lord. All right, guys, if you want the numbers right now, they're going to be on my Twitter. Finally, website's updated. Golly, that was a freaking long time. Q4. Numbers are there, guys. Here we go. Here we go. Website is updated. Never seen it take that long in my life. All right, guys, we got, see, wow, 37% growth. Pretty, not as high as we expected. 37% growth. Let's see if we got everything updated so you can see. Okay, everybody can see the number. Let me pop, make them a little bigger. There you go. All right, we got the official numbers. Record adjusted EBITDA 318 million. GAAP net income 174. I think I had an 18% GAAP net income margin. I got to look at my number. I think my numbers were 190. So 13 cents. The analyst wanted 11 to 12. Fee-based revenue up 53%. Financial services and tech platform revenue 579 million, 61%. Record loan originations 10.5. Total deposits are accelerating. Look at that. That's a crazy number. Look at that. 4.6 billion on deposits. That's a big number. Cross buy right here is at 40%. LPB originations increased to a record 3.7 billion. Okay, let's get it moving. Let's get it moving. See what we got. Members finished the year. New members. What I want to see what are the total members, but all right, they finished the year at 481 million net income. Fee-based revenue 1.5 billion. Look at that. Adjusted EBITDA margin finished the year at 28%. Rule of 40 was 68, so they didn't get that the Chime boost. There's no way that number came in. That Chime $30 million boost that did not come in for the quarter. Let's see. So it looks like right here, lending, the contribution margin really is starting to drop for the year, 4%. Okay, let's see. Looks like personal loan net charge-offs ticked up a little bit right here, 4.2 to 4.4. Yeah, a little bit. Let's see. All right, here we go. Guidance. Okay, net revenue. Oh, wow. Let's see. Full year 2026, they guided 30% growth. Okay. Analysts wanted 28. So they're already starting over the analyst estimates, which is good. They wanted 28, so they didn't go under. Thank the Lord. And net income, they guided 825 million. That's not bad. It's 100, almost 100% growth. What is that? 480, 960 is 100% growth. So it looks like they might be going for 100%. Okay. They went with 60 cents. They beat guidance. Okay. What do you think, guys? They beat the guidance. The guidance was 55 cents. What do you think? 60 cents. What do you think? They beat it. Not bad. I mean, I'll take it. They beat the 55. So I think they're gonna finish the year at 80. It's not bad. It's not bad. We were praying that, remember, they said the low end was 55. Maybe they wanted to invest further. Maybe they were gonna guide 50. I didn't want 60. I wanted 65. But hey, they beat guidance, okay? It was 55 cents. So they sandbagged, but they didn't sandbag us to oblivion at 55. Still not happy, but I would have wished for 65 as a start. But hey, they beat the revenue, the top end, and they beat the EPS bottom end, both on analysts, guys. So right here, analysts wanted 28. They came out at 30. Analysts wanted 55. They gave you 60. Q1 growth 35, adjusted EBITDA 300. Yeah, definitely a sandbag for Q1. They shouldn't even have gave Q1. They should have just provided full year. Okay, let me look at some of these numbers and see what's really starting to pick up right here. All right, home loan originations are ticking up for a new record. Wow, student loans are ticking up, so you got a record. It just looks like the personal loan segment slowed down a little bit for Q4. Like you can see, it was 7.48 to 7.5. So personal loans really is the only thing that didn't tick up crazy. Um, technology platform revenue, not bad, 122. Wow, expenses came down a lot. Their profit went up to 47 million. Let's see if the chime in there. That's the real question. But got technology's up 122. Financial services 420. Ah man, yeah, that was a little low. 456. That's what it is. That's what it is. It looks like technology or the financial services segment. Look at this. Went from 420 to 456. That was the number. I had this a little bit too high. Um net revenue. Well, every analyst has to pick up their numbers now because if you look right here, guys, all of analyst price targets, look at this right here. They were all at 55. Okay. Now, boom, you're going up. You're starting from 60. We know how SoFi likes to operate. They're probably going to finish the year at what? 75, 80. So you got sandbag, but you didn't get sandbag to Mars, at 50 cents, 55. Thank God. But I kept pushing on Twitter. Don't put 60. Don't put 60. Don't put 60 to Noto management, everybody, just praying that they put out 65. And I did my best, guys, but they didn't start you off at 65. So yeah, if we're starting like this, guys, think about this. Like if we're starting like this at 30, they're gonna grow 40% this year. That's insane. Okay. If they're starting at 30, they're gonna grow 40. This net income could go up a lot. Um, yeah, hopefully we finish the year at 75. So yeah, this is a solid number right here. This is a pretty decent number. Stocks up 4%. I don't know. I don't know. Well, what do you guys think? Here we go. Let's see. Sandbag party. Yep. 60 cents. Yep. Not worth getting up. Yep. 60. You got over $1 billion in revenue. You beat the analysts. Hey, at least you beat the analysts. The 55. Yep. People aren't. Here we go. Look at Noto's tweet. Let's see what Anthony Noto said. Okay, here we go. 2025 was an incredible year and our best year, and our outperformance in Q4 was nothing short of exceptional. This quarter we broke records across the business with 1 billion adjusted net revenue, 1 million in new members, 1.6 million new products, 37% year-over-year revenue growth, 35% member growth, 37% product growth, 29% EBITDA margins, which puts SoFi in a rarefied air for both revenue and profitability. Talking about probably the rule of 40. Yeah, I mean, we just know, yeah, they like to start low, 60 cents, and hopefully finish the year at 75 next year. So yeah, they know what they're doing. They're ahead of analysts on revenue and profitability, EPS. We looked at the numbers. 55 was what all analysts wanted. They beat the numbers. They beat the analysts. It wasn't a blowout. So that's it. That's it, guys. What do you think? It's if you think about it like this, so this is where you have to, as an investor, think about what they're actually going to do for the full year. This is what's going to happen, okay? Let's assume they hit 75 cents, right? Let's assume they hit 75. Would you guys think that's possible? Yes or no? Would you think do you think 75 cents is possible? Yes or no? Okay, I think it is. Okay, so think about this. We're at 60. Last year or this year we finished the year at 39. So we're going to do wow. This is wow. Okay, wait till you see this. Wait till you see this. All right, guys. So I put a number in, okay? Look at this. We put up 75 is ambitious but possible. So what do you think they're going to hit? 70? You think they'll finish the year at 70? Maybe you're right. Maybe it is 70. Okay, let's just say 75. That is going to be that's 90% growth a year over year in EPS. So 75 is 90% year over year growth. So you're going from 39 to 70 75, 90% growth. So you're getting 90% growth, okay? Think about that. 90% EPS growth is what we could be looking at. He said no way. Okay. This guy said 80, this guy said 70, so that's why I said 75. I know they're going to hit 70. There's no way they guide 60 and don't hit 70. So anyone saying they're going to hit 65, 68 is crazy. They are not going to be in the 60s. They are going to be at least 70. But let's just say 75. You're getting 90% growth, okay? EPS, 90% year over year growth. Insane. And I'm telling you, that revenue number that they guided 30, it's going to come in at like 38.40. So you're talking 40% top line, 90% bottom line growth. That's insane. You know, it's just the numbers that you're seeing now aren't what you're going to likely see at the end of the year. But 40% top line, 90% bottom line. Most of these companies growing 40% don't even have profits yet. No profits at all. Nothing. If you're growing your bottom line by 90%, it's insane. Yeah, guys, they're gonna hit 75 cents this year. That's 90% growth. So, yep, 75 isn't possible. What is that? 16, 18, 20. Is that what it is? Let's see, 16, 18, 20, 22. Yep, you're right. 76 cents. 16, 18, 20, 22. Yep. All right. I'm pretty happy with the I'm thankful that they didn't I'm just thankful they didn't say 50 or 55. I'm thankful. I tried to push management to do 65 to start, but that would have been too much pressure on them because they would have been over 10 cents from analysts. You know, the analysts started at 55. So yeah, these are the most important numbers right here, guys. You got the 1 million members, you got the 1 billion. You are 100% S&P 500 approved right now, like qualified, okay? That's probably what they were really going for. They wanted to make sure the numbers, you know, they didn't push their numbers too far out to, you know, miss a quarter to, you know, for that market cap to come down, but your S&P 500, boom, your stamped approval, you got it. You know, that's what we really wanted, guys. The S&P 500 is there for you. You got 1 million members, you got a billion in revenue, you're guiding 30% growth, potentially 90% EPS growth. I mean, this is, you know, SoFi, you know, it's a sandbag to you guys, but this isn't as bad as they usually do. They went above and beyond of what all analysts wanted, and not bad, not bad, not bad. Let's see. Well, what are we? Kalash. Oh yeah, that's a good idea. Let me take a look. Eh, it didn't really move. It's at 50. Let's pause. Uh, let's see. All right, let's take a look at the. Yeah, guys. Every analyst on Wall Street right now, you got to remember, they're all at 55. Even the Bank of America guy is like, what is the Bank of America guy at 50, 55? I can't remember if he's at 50 or 55. Every single one of them, they have to come up to 60. You know what I mean? They all got to come up to 60 cents. So their numbers are what their numbers are right now. Now they got to, increase their numbers to 60 cents. So SoFi did the right thing, but obviously I wish they would have said 65 because that would have been a big beat from the 55 analysts wanted, but they didn't want to put too much pressure on their back to get a little bit too far ahead of the analysts the first quarter of 2026. So they hit it was 68. It was 68. I thought it was gonna be higher at like 72, but it looks like financial services wasn't a super blowout. Maybe the loan platform business slowed down a little bit, but guys, we got a new Fed chair today. Potentially dovish, he's gonna be dovish with Trump on his neck 24/7, and he obviously has agreed to that. So you got a dovish Fed, and you beat all analysts on Wall Street. They're 55. You beat every single one of them. Their revenue was 28. You beat every analyst on Wall Street's revenue. Look, they were at 28. We're at 30. They're at 55. We're at 60. You beat earnings. You hit 1 million members. You hit $1 billion in revenue. Your 2026 EPS beat by 5. Your growth rate beat by 2. And people know that SoFi likes to sandbag. Do the math. If you put up 40% growth and 90% growth, this company is going to have $5 billion in revenue, potentially. $5 billion in revenue, potentially. 4.9. And EPS about 75 cents. They're already got a margin of 18%. That's pretty good. Adjusted EBITDA. Look at the adjusted EBITDA, guys. You're going from 1 billion to 1.6 billion. So if you see the adjusted EBITDA is going up about 550 million. I mean, do the math. I mean, if your net income goes up 450 million, I mean, you're at 900 million already. Yeah, guys, they're gonna hit 75 cents this year. So they were completely accurate. They guided 55 to 80. They're gonna finish the year at 75. I'm pretty happy if they hit 75 cents this year. It's not bad at all. Let's see. It will fade later. Yeah, maybe crypto and government shutdown. That's really all you got. I mean, let's see. I got 1 second. All right, guys. The call is at 8 o'clock. Call is at 8 o'clock. Is it? I don't know. The tech platform, they did pretty good this quarter. I had the numbers. Let's see. Maybe members went down, but let's see. Yeah. Oh wow, you're right. Wow, yeah, the tech platform, the accounts went way down, but the revenue's going up. I think it's those damn airlines. It's gotta be those airlines, right? Let me see. Yeah. Million members, cross-buy accelerating. This total deposits is insane. This is their biggest number ever. 4.6 is their biggest number ever. 1.7 billion quarter over quarter. Tangible book. Launched SoFi USD. Launched a smart card. Further expanded the loan platform. Brand awareness all-time high. It's not bad, guys. This is pretty solid. I mean, I want to see the loan platform business. Let's see what we got. Yeah, they just backed off personal loans for Q4. That's really it. They just backed off personal loans, accelerated home loans, and accelerated student loans. That's really good. That's lowering their risk. Yeah, we could be looking at a really big. If they grow 40% this year and 90% on the bottom line, it's gonna be a huge, huge year. Yeah, look, technology platform revenue. Look at this, guys. 114 and 122. It's moving up. And look at this. They put a big profit down too. 47 million profit. That's their biggest profit. Look at this. 30, 33, 32. They dropped 47 million to the bottom line on technology platform. Even though accounts are down a lot. That's looks like technology platform might be firing on all cylinders right now. Adjusted EBITDA came up a lot too. Look at this. 276 to 317. Wow. Yeah, these are some pretty good numbers. I think yeah, I think they got Chime fully off the platform. Chime was like one of their biggest customers, and revenue's still going up probably because these all these airlines are going to start kicking in. 26. I mean, you got 5 analysts over 35 already right now, so I don't know. I think it should be over 30. Um, they're literally going to be they're hitting about a billion in profit. They're gonna probably hit a billion in profit this year. So that puts your PE right now at about 31. Your PE is only 31 for a company growing their top line 40%. That don't really make sense. If you're growing 40% top line, 90% bottom line, that's not you don't get a 30 PE ratio. You get way higher than a 30. Yeah, just do the math. 40% growth rate, 90% EPS. Oh yeah, we got triple B. We beat all the guidance too. And stocks up. I mean, the stock's up 5.5. I mean, I think institutions understand that SoFi is not playing around, and they're getting in the S&P 500. They're not making any mistakes on their earnings right now. Nothing. Members, revenue, profitability, revenue guidance, EPS guidance. No mistakes. You got your let me check the balance sheet. What am I doing? Let me look at the balance sheet already. Let's see what the balance sheet is. That's what we got to do. What are we doing? What are we doing right now? Cash and cash equivalents. $5 billion. Are you kidding me? They got $5 billion in cash. Total debt 1.8 billion. Dude, did they wipe out? Guys, we gotta look at this real quick. Let's just take a look at this real quick, okay? Let's take a look. I think they're really gonna hit 75 cents now that I'm seeing this. Are you kidding me? Are you kidding me? Let's see. All right, let's take a look at this real quick, guys. Okay. Remember I told you these guys are not they're not playing games for the SP 500 inclusion. This is going to prove it to you. All right, look at this, guys. All right, you got what does that say? That says total debt 1.8 billion, right? They got 1.8 billion, right? Now look at this. Watch this. 1 second. Last quarter they were at 2.7 billion. So they just knocked down debt $1 billion. You see that? Look at that. 2.7 billion last quarter. 1.8 billion this quarter. They literally knocked out all the warehouse facilities. Look at this. The warehouse facilities are gone. They got rid of all this. So they knocked down debt, and their cash position was only 3.2 billion. Now their cash position is 5 billion. So they went down $1 billion in debt and up 2 billion in cash, guys. Do you see that? I mean, this is fortress-like balance sheet now. They have almost I don't know. They got doubled cash compared to debt now. I mean, their debt's getting real small. They could pay all this debt down if they want. I mean, I think they're gonna blow out EPS this year, 75 cents easy. I mean, do you see the shift in the balance sheet? I mean, they just went up 2 billion cash, down 1 billion in debt. That's insane. And they're giving you 40% growth rate this year. I'm telling you, they're gonna hit 40% growth. It says 30, they're gonna hit 40. This thing is gonna be a monster by the end of this year. Monster company. So this is they did everything. I think they did everything that they wanted to do that Wall Street institutions wanted to see. Like they just did the S&P 500 stamp of approval. I'm telling you, everything is flawless. They didn't get too aggressive on the EPS. They could have guided 65, finished the year at 80. They beat analysts. They beat them. They changed their entire balance sheet. Debt's down, cash up. Who's going to complain about a 40% growth rate this year in 2026? Who's going to complain about 40% growth? Most of these companies growing 40% have no profits, nothing. Some of them don't even have revenue. They're gonna put up $1 billion in profit this year. So if you do the math, and if you can't trust their guidance, if you use your guidance, listen to this, guys. If SoFi puts up $1 billion in profit, okay, their market cap's 31. The PE ratio 4P for 2026 right now. Remember everybody saying 90, 70 because of last year, our baby EPS. We're at a 31 PE ratio. It's 31. If you trust your guidance, you're trading at a 31. Come on, guys. This is you're Walmart's at 45 PE ratio right now. This is insane. We're trading at a 30 times PE. Your analysts, every single analyst that I gave you, None of them were projecting 30% growth and 60% EPS into their numbers. None of them. They were all at 55 cents. And now you're going to have this guy, and this guy. They're going to all be at probably $40, $39, $40. These two might come up to like 37, 38. You're going to start getting some 40s coming out. Even the Bank of America guy, he was guiding like 50. So if the Bank of America guy is guiding 50 and he's giving you a $20.50 price target, he's got to come up to $22, So Bank of America has to come up. You're literally trading at, right near the most bearish analysts on Wall Street right now. You know what I mean? I, I really think the only thing I could say about this entire report is, they could have guided 5 cents more. We know they like to beat and raise every quarter, 15% gap. They just didn't want to put the pressure on their back to miss. This is I think everything they did this quarter is for S&P 500. I mean, they wanted it flawless. I need to tweet about this on the Twitter. Like SoFi, Jesus, the difference in balance sheet is insane. Okay, I'm gonna watch it. Watch this tweet I put out. Okay, watch this tweet I put out, guys. This is gonna be a flawless tweet. If you guys go and check out this tweet, I'm gonna show you the tweet I want to put out. It's gonna be flawless. These are. Watch this. SoFi now. This is insane. All right, 1 second. The tweet is almost done. One second. 4918. Okay. And we have 227. All right. The tweet is out if you guys want to check it out. That's how I do it. I get the information to everybody to see what's really going on behind the scenes. All right, let me show you the tweet I just made. If you guys want to see it, ready? Check this out. What do you think? This is the tweet. What do you guys think about that tweet? SoFi has now a S&P 500 gold standard balance sheet. Q3 cash, 3.2 billion. Q3 debt, 2.7 billion. Q4 cash, 4.9 billion. Q3 debt, 1.8 billion. Is that not like a insane tweet right there? What do you think? It's pretty insane. And you beat all analysts on Wall Street, revenue and bottom line EPS. That's pretty crazy, honestly. If you really look at the damn it, you're right. Thank you. I messed up. Fuck. See? Tweet so fast. Thank you. See? Sometimes you mess stuff up. See, sometimes you mess it up. Gotta get that. See? Thank you. See? Tweet so fast. Appreciate that. All right, fix it. Pretty insane. And you got the triple beat. Yeah, guys, this is what we wanted. We wanted to be S&P 500 ready. We are S&P 500 ready now. Appreciate it. Good morning. All right, guys, you're going to get the earnings call in 12 minutes. Man, if this is a sandbag, oh my God. If these were the sandbag numbers we got, I mean, I'm just thankful the revenue is at 30 and the EPS came up from the bottom end 55. Oh man. This quarter would have been flawless if they would have guided 65 because you know they're going to come in at that 80 and 5 cents. Isn't that crazy what makes the entire difference? Just 5 cents. We were all fearing, like, look at this tweet. Look at this tweet I put out last night. Let me show you this tweet I put out real quick. 1 second. Here, I'll show you the stock. Stock's doing pretty solid. Let me show you the tweet I put out last night. So I put this tweet out. 1 second. See, look, this is what I said last night, and tell me I wasn't accurate with this. How accurate is my tweeting, guys? The market believes SoFi will guide 55 cents EPS tomorrow. If we guide 65 EPS guidance, we could launch fast. I really thought we would have been up 15% if we would have got to 65. So you telling me this tweet isn't extremely accurate? I think it is. We came close. We came in at 60, but we're starting at 60. Remember, SoFi is the sandbag of all sandbags. You know, they like to sandbag. These dudes can push that 60 to 75. They can push it to 75 cents. I'm pretty happy. I would be happy this year with 75 cents as long as I got my 40% growth rate. So let's just hope they can hit 75 this year, guys. That'll be awesome. Yeah, guys, I'm telling you, all the analysts, you got so many analysts right now. You know, I'm pretty happy now that I'm absorbing the numbers. I'm really happy because, like I said, you got that fortress balance sheet. Look at that balance sheet, guys. Do you guys see that balance sheet? That's insane, right? Cash 3.2. We thought that was good last quarter. Debt 2.7 billion. Now they're at 4.9 billion cash, 1.8 billion debt. This means if they choose, guys, think about it like this. They could pay off all their debt tonight if they wanted to. Debt gone if they chose to. But they can, they can still manage their debt right now with all this cash. I mean, they're going to grow 40%. I'm so happy if they grow 40% with 90% bottom line. Man, these are some good ass numbers. I thought 65. We didn't get to 65, but man, besides that 65, man, they are S&P 500 ready right now. This is a S&P 500 company right now. 40% growth rate we're looking at. I know they guide in 30, but you're looking at the sandbag of all sandbag companies. Who doesn't think they're going to guide? Who doesn't think they're going to hit 40% revenue growth this year now? Come on. You don't think SoFi is going to hit 40% growth and they just guided 30? That means Q1 they would go up to 32, Q2 34, Q3 36, Q4 38, finish at the top end, maybe 39% growth. They're going to grow 40% this year. This company gave you, remember, Noto said we want to compound at 20 to 25% for the next 5 years. Remember he said that? We want to compound at 20 to 25% in the next 5 years. This ain't 20%, 25%. You're getting to 40% this year. These are some they just wanted S&P 500 numbers, guys. Oh wow, the Kalashi updated. Wow. Yeah, Kaushi. Yeah, it's up now. It's at 57 now. Yeah, it went up. It's way higher. And I'm telling you, this is the number one financial service company by market cap. I'm pretty happy, guys. I know a lot of you guys wanted the 65 cents, but oh yeah, definitely the offering. Yeah, the offering is juiced them up out of their mind. Yep. 40% growth rate. This company's growing 40%. A lot of I can show you companies, I can show you 3 software companies that are growing 40% and they don't have any profits, nothing. Still, they're losing hundreds of millions of dollars. Oh yeah. You telling me they're not gonna have, a bigger guidance with, another 3 rate cuts this year? 2026 and 2027 is where SoFi gets ahead and is, you know, if anybody doesn't see this coming, I mean, they're going straight to 10 billion in revenue, Probably margins by that time when they hit 10 billion, margins will probably be 30%. So that'll be a $3 billion profit. It's going to take a while, but they're on their way to 10 billion in revenue. This year we could hit 5 billion, next year 6.8 billion. It's not bad, guys. I mean, oh yeah, we're getting rate cuts. Once Trump's boy steps in, we're getting some rate cuts. Powell, you know him, he's too old school. Powell ain't doing nothing. He ain't gonna give anybody no damn rate cuts. He's done. He's washed. All right, guys, we got the earnings call in 5 minutes. Yeah, if we get 3 cuts this year, we are going to SoFi's probably gonna grow, I'd say 42%. They'll grow 42% if they can get 3 rate cuts. Another great quarter. Yeah, it was a great quarter, honestly. I think institutions will front run this S&P 500 inclusion. I'm telling you, these are the numbers they wanted to see. They know SoFi sandbags. I'm telling you guys, this quarter was for institutions. This was a quarter they did for, hey, you want to invest in us before S&P 500? Do it right now. Because we're going to grow 40% this year. And we're going to have 90% bottom line growth. Yeah, guys, this is a good quarter. Good guidance too. Pretty good guidance. They beat all analysts on Wall Street. My God. Fastest financial technology company growth in America. Yeah, it's like 50, 57. It's jumping up a lot right now. It's like 57. This is we get that government shutdown overhaul off our shoulders. Got the new Fed chair. SoFi's S&P 500 numbers. Man, guys, I can't. Let's see. How's the market looking right now? That's what I want to know. How's the market looking? Is the market bad right now? How's the market looking? That's the real question. How's the US stock market looking right now? Anybody got an update on that right now? Let's see. Looks like all the Bitcoins are down 2.5 to 3%. Yeah, we got a couple stocks up. We got a couple stocks green. We got Tesla's green, Robinhood's green, Micron's green, SoFi's green. Yeah, I mean, yeah, the index is down, but yeah, some stocks are green right now. Let's see what the headlines are on SoFi. Here we go. Let's see the headlines. SoFi Q4 maintains strong revenue and operating momentum. Yeah, this is a good headline. SoFi full year adjusted 60 cents, consensus 55. Yep, they're smart. Guys, they're smart. I mean, I know we didn't want 60, but they just beat analysts. These guys are smart. Analysts wanted 55, they put out 60. These guys are not missing the S&P 500 inclusion. They're not missing it. SoFi sees full year adjusted revenue at 4.6 billion. Record net revenue of $1 billion. Record members and yeah, guys, this is a good quarter. This is a really good quarter. These guys know what they're doing, man. These guys know what they're doing. Just gotta give it a little time, guys. Gotta let them talk a little bit, see what's going on. Man, there's some good numbers. All right, guys. Earnings call is starting now.
Thank you and good morning. Welcome to SoFi's fourth quarter and full year 2025 earnings conference call. Joining me today to talk about our results and recent events are Anthony Noto, CEO, and Chris Lapointe, CFO. You can find the presentation accompanying our earnings release on the investor relations section of our website. Unless otherwise stated, we'll be referring to adjusted results for the fourth quarter and full year 2025 versus the fourth quarter and full year 2024. Our remarks today will include forward-looking statements that are based on our current expectations and forecasts and involve risks and uncertainties. These statements include, but are not limited to, our competitive advantage and strategy, macroeconomic conditions and outlook, future products and services, and future business and financial performance. Our GAAP consolidated income statement and all reconciliations can be found in today's earnings release and a subsequent 10-K filing, which will be made available next month.
Clear?
Our actual results may differ materially from those contemplated by these forward-looking statements. Factors that could cause these results to differ materially are described in today's press release and our subsequent filings made with the SEC, including our upcoming Form 10-K. Any forward-looking statements that we may make on this call are based on assumptions as of today. We undertake no obligation to update these statements as a result of new information or future events. And now I'd like to turn the call over to Anthony.
Thank you, and good morning, everyone. 2025 was a tremendous year on all fronts. Our member focus drove an unprecedented level of innovation across our business and led to the strongest financial performance in the history of our company. As we begin 2026, we're positioned for another year of unprecedented results, and I could not be more excited. We come into the year with a differentiated one-stop shop model with a full suite of products that allow members to borrow, save, spend, invest, and protect better. A demonstrated track record of driving durable growth through continuous innovation, resulting in compound annual growth of nearly 50% from $240 million in 2018 to $3.6 billion in 2025. A scaled member base of 13.7 million members, more than 20 times larger than the 650,000 members we had in 2018. And our highest brand awareness ever at nearly 10% versus roughly 2% in 2018. Despite that unprecedented growth, we still have massive addressable markets across our existing businesses and huge opportunities for growth in newer areas like crypto, AI, and business banking. And finally, we have a fortress balance sheet, which we further strengthened through $3.2 billion in new capital, increasing our tangible book value by $2 per share to $7 per share, giving us a broad range of optionality. This gives me great confidence that we will continue to drive durable, compounding growth for years to come, resulting in superior financial returns. I will discuss some of what we've planned for the year ahead in a moment, but first, let me begin with our key results for the fourth quarter. Starting with the drivers of our durable growth. We added a record 1 million new members in Q4, increasing total members by 35% year over year to 13.7 million certified members. This was our first time adding over 1 million members in a single quarter. We also added a record 1.6 million new products in Q4, increasing total products by 37% year over year. We now have over 20 million products. Cross-buy continues at an exceptional pace, with 40% of new products opened by existing SoFi members. Over the past year, our cross-buy rate has increased by 7 percentage points. This clearly demonstrates the effectiveness of our one-stop shop strategy and our ability to build deeper, multi-product relationships with members. And that is before we fully leverage new technologies like artificial intelligence. Our strong member and product growth powered our revenue growth in the fourth quarter. Adjusted net revenue was a record at over $1 billion, up 37% year over year, marking our first billion-dollar quarter. Together, financial services and our technology platform generated revenue of $579 million, an increase of 61% year over year, and representing 57% of total revenue. In our lending segment, adjusted net revenue grew 15% year over year to $486 million. This was driven by strong originations in the segment of $6.8 billion, a 13% increase from the prior year. Combined with the very strong loan platform business originations of $3.7 billion, total originations reached a record of $10.5 billion for the fourth quarter. This is our first quarter originating over $10 billion in loans, demonstrating our ability to originate high-quality loans at scale. In fact, through all of 2025, we originated over $36 billion of loans. I am also proud to report that total fee-based revenue across our business was a quarterly record at $443 million, up more than 50% from the prior year, driven by a strong performance from our loan platform business, referral fees, interchange revenue, and brokerage fee revenue. On an annualized basis, we are now generating nearly $1.8 billion of fee-based revenue, up from less than $1.2 billion in the fourth quarter of 2024. This reflects our deliberate diversification towards more capital-light revenue streams. In addition to delivering durable growth, we delivered strong returns and profitability. In the fourth quarter, adjusted EBITDA was a record at $318 million, up 60% year over year. Our adjusted EBITDA margin for the quarter was 31%. This is above our original goal of long-term margins of 30% set when we went public. Our incremental EBITDA margin was 44% as we continue to balance reinvesting in the business to drive long-term growth and profitability. Net income in the quarter was $174 million at a margin of 17%. Earnings per share were 13 cents. Finally, our tangible book value ended the year at $8.9 billion. In 2025, we grew tangible book value by over $4 billion and $2.54 per share. Our diversified business is uniquely built to deliver a winning combination of growth and returns. In the fourth quarter, we achieved a Rule of 40 score of 68%, once again demonstrating the strength of our model and our solid execution. The consistency with which we've exceeded the Rule of 40 continues to put us in rarefied air among fintechs and technology companies more broadly. Despite these exceptionally strong results, I know that we are just getting started. We are still just scratching the surface of the opportunity that exists across each of our existing products and the newer areas like crypto. Given these dynamics, I've never been more optimistic about our prospects than I am today. This is why we will continue to invest heavily to make our existing products even better by providing the best speed, selection, and experience, to build new products to help our members get their money right, and to further strengthen our trusted brand name. Our investments will power durable compounding growth and drive stronger returns as we continue to scale. Let me now spend a moment discussing our brand building efforts, which are key to driving new members to SoFi, feeding our productivity loop and growth. In 2025, we significantly increased our brand strength and stature through our first ever music partnership, including becoming the presenting partner of the CMA Fest and partnering with country music star Kelsea Ballerini, and by expanding our sports partnerships. More recently, we signed reigning NFL MVP Josh Allen to Team SoFi. Josh has been instrumental in showcasing the most valuable product in financial services in SoFi Plus. This partnership included ads across some of the most watched NFL games of the season and has continued through the existing postseason playoffs. So far, this has been one of our most successful campaigns ever, more than doubling the effectiveness of our advertising in the target market. This year, we also kicked off Season 2 of TGL presented by SoFi, with exciting play from the biggest names in golf. So far, the season off to a great start, building on the momentum from last year with viewing audiences up 22% versus a year ago in the first 5 matches. And later this year, the World Cup will be coming to SoFi Stadium in Los Angeles, allowing fans worldwide to get a glimpse of the nation's most advanced stadium and the most ambitious stage in sports and entertainment. Our marketing efforts continue to have a strong effect, driving unaided brand awareness to an all-time high of 9.6% during the quarter. That's up 250 basis points from the fourth quarter of 2024, a 33% improvement. Turning now to our product innovation across our business. At SoFi, we are one team united under a common purpose of helping people achieve financial independence to realize their ambitions. We are passionate about meeting our members' needs, driving us to work harder and innovate more rapidly to bring them the best products and services in the market. We call this the SoFi Way. Guided by the SoFi Way with a differentiated business model and capabilities, we are uniquely positioned to benefit from both the crypto and AI technology supercycles taking place. Only SoFi has the strength and stability that comes with being a national bank, a tech-driven culture with a track record of innovating in the financial services industry, and a large and growing member base that embraces innovation. A full set of products that allow us to leverage crypto and blockchain technology in a number of innovative ways, and a technology platform that allows us to innovate more rapidly and serves as a channel to support business clients. Since March, when the OCC made crypto permissible for national banks, we've moved with urgency to bring new products to our members. In October, we enhanced our unprecedented money movement offering with the launch of SoFi Pay, our first payment product that leverages blockchain technology to provide fast, seamless, low-cost, and safe international payments. We've already expanded SoFi Pay to include over 30 countries, including Mexico, India, the Philippines, Brazil, and much of Europe. SoFi Pay is available to all members right in their integrated SoFi app, making money movement easier than ever. In November, we announced SoFi Crypto, once again giving members the ability to invest in dozens of tokens directly in our SoFi app. As the first nationally chartered bank to launch crypto trading for consumers, our members can instantly buy cryptocurrencies from their FDIC-insured deposit account, which is a very meaningful difference. At other providers, customers' funds sit uninsured, earning no interest as they wait to fund digital asset purchases. At SoFi, those funds sit in a SoFi Money account, protected with insurance and earning up to 4% interest. In December, we took an even bigger step forward through the launch of our own stablecoin, SoFi USD. This launch made us the first national bank to issue a stablecoin on public permissionless blockchain. Once again, this is a meaningful step forward in differentiation versus the landscape. For every SoFi USD outstanding, we will have $1 of cash in our Fed master account, which means there is no credit, liquidity, or duration risk, and we will share economics with partners for their marketing and distribution services. SoFi USD will be a game changer for our business as it enables us to be an infrastructure provider for banks, fintechs, and enterprise platforms, positioning us at the center of the crypto ecosystem. As you can see, we're moving quickly, but we have a lot more to do to accomplish our ambitious plans over the near and medium-term horizons. This year, we will leverage SoFi USD to power SoFi Pay, and we'll continue to add more countries to the offering. Over the medium term, we plan to offer a SoFi Pay experience to people outside the United States, allowing them to receive, send, hold, and spend money anywhere, all supported by SoFi USD. This initiative could serve as a launching point to build our brand in a more global way. In 2026 and beyond, we will look to offer additional crypto products and services, including secured lending by cryptocurrencies, which will give members better rates on their loans, institutional trading, and correspondent payments and settlement via stablecoins. For members that hold SoFi USD, we will look for innovative ways to provide them with benefits such as interest or other perks. Beyond our member-facing initiatives, we are hard at work building our business banking offering, which will begin to launch in 2026. Our ambition is to be the bank for businesses and other financial institutions that want to transact in both fiat and cryptocurrencies, filling a critical gap that has existed in the market. Leveraging our tech platform capabilities and SoFi USD, over time we will build an offering that includes institutional crypto trading, making us the first national licensed bank to offer this service, stablecoin as a service, crypto card issuing, digital asset custody and infrastructure services, and the ability to interchange fiat and digital assets in real time through our SoFi Exchange network, as well as the ability to settle transactions 24/7 on a virtual ledger. We have brought on significant expertise from the crypto and banking industries, and I couldn't be more excited to see this business take shape in the coming years. Turning now to SoFi Smart Card, which we launched in the fourth quarter. This new all-in-one card and account allows members to earn significant rewards and an industry-leading APY while also growing their credit score. Here's how it works. Members can use their SoFi Smart Card to make purchases just like a typical debit or credit card. Purchase amounts are automatically set aside from the deposits in their SoFi account in real time. The balance can be paid in full each month via funds on hand or an alternative bank account or source of funds. And all the while, members earn unlimited 5% cash back rewards at grocery stores. We built and launched Smart Card in just 4.5 months with the help of our tech platform, a feat that would not have been possible had we relied on another party. This demonstrates once again how our tech platform gives us a greater ability to customize and launch financial services products faster than competition. Beyond helping drive innovation across SoFi's financial services products, we are excited to see renewed energy around innovation within financial services more broadly. This started to take shape in 2025 with big consumer brands like Southwest Airlines and United Airlines coming to us to help them launch new programs that drive greater loyalty and engagement from their customers. Now we are seeing strong interest from an even wider range of companies, including those based internationally, who see the highly supported business environment in the US, particularly for crypto, and are interested in launching new products here. Our tech platform business is in a prime position to support these enterprise clients. Turning to Invest. 2025 was a blockbuster year for SoFi Invest, in which we significantly expanded our offering to give members the best selection, including investments that have been traditionally reserved for the ultra-wealthy. We gave members access to private companies, including SpaceX and Epic Games, access to invest in alternative investments through private market funds managed by Cashmere, Fundrise, and Liberty Street Advisors, access to invest in IPOs, including Klarna, Gemini, Figma, and StubHub. We launched level 1 options in our own SoFi Agentic AI ETF. We made rolling over 401ks easier and more efficient, and we continue to make our user interface even more intuitive and engaging. This expanded offering helped drive a 2.2x year-over-year increase in the brokerage revenue, helping drive Invest closer to full profitability, which we expect to achieve this year. Turning now to our lending segment, which continues to drive strong revenues and allows us to support members at key points in their lives. We show up with a simple but differentiated message. We are here to help you get your money right. Our personal loan product does just that. With a SoFi personal loan, members can refinance absurdly expensive credit card debt held at other institutions so they can stop paying for other people's rewards and focus on their own financial well-being. For example, if a member is able to refinance $40,000 of debt on which they were paying 24% interest with a SoFi personal loan that has an interest rate that's 10 points lower, they can reduce their monthly payment by nearly $200, moving closer to becoming debt-free. If we translate that example across the more than 500,000 loans that were originated in 2025, you can see that we're having a massive impact on our members' lives. SoFi is the preeminent company offering personal loans, originating roughly 15% of total U.S. prime volume. However, the opportunity remains massive as the real addressable market is the nearly $1 trillion of prime revolving credit card debt just sitting there waiting to be refinanced at up to half the rate. And that $1 trillion opportunity is before even considering the additional debt that is outside of our traditional credit box, but could be refinanced through our loan platform business. Our student loans are also designed to help our members get their money right. Here too, we have become the preeminent company for refinancing student debt, having a massive impact on our members' lives. We estimate that we will save our members over $400 million in interest expense just on the student loans we refinanced in 2025. Despite our strong market share in the student loan refinance market, we see continued opportunity for growth. We estimate the total market opportunity to be around $400 billion, which would increase by 25% if rates were to drop 50 basis points. In addition to refinance, we've launched new private in-school student loans options to help people finance their education, filling the gaps left by the federal graduate programs. These include medical, veterinary, dental, and STEM loans, with more coming soon. Turning now to home loans, where we had our best year of originations and where we are primed for an acceleration in growth when rates decline. In 2025, we originated $3.4 billion of total home loans, surpassing our prior record set in 2021 when the real estate market was at its height. In fact, in the fourth quarter, we originated home loans at an annualized pace of $4.5 billion, nearly 2x the pace of the prior year. And the opportunity for continued growth is massive. Within our own member base, about 90% of those that have home loans have them with other institutions. As rates come down and many of these members look to refinance, we'll be in a prime position to win that business. Additionally, as others within our 13.7 million strong member base look to purchase a home for their first time, we believe they will come to SoFi as a trusted partner. As you can see, 2025 was an incredible year by any measure, our best year ever. We leaned into what sets us apart, our unique one-stop shop strategy, our ability to innovate, and our relentless focus on helping members get their money right. Heading into 2026, we see a tremendous opportunity, and we continue to be energized by our values and the SoFi way to capture it. With that, let me now turn the call over to Chris to discuss our financial results for Q4 and 2025.
Thank you, Anthony. 2025 was an exceptional year. Adjusted net revenue for the year was a record at $3.6 billion, up 38% year over year. Adjusted EBITDA was also a record at $1.1 billion, up 58% year over year, at a margin of 29%. This was our first time surpassing $1 billion of EBITDA. Net income was $481 million, at a margin of 13%. Net income was up 2.1x, excluding one-time items in the prior year, and earnings per share was 39 cents. We finished the year strong with a great fourth quarter. In Q4, adjusted net revenue grew 37% year over year to a record $1.013 billion. Adjusted EBITDA was also a record at $318 million and a margin of 31%. Net income was $174 million at a margin of 17%. And earnings per share was 13 cents. This was our 9th consecutive profitable quarter. An important driver of our growth was the increased contribution from capital light, non-lending, and fee-based revenue sources. Our financial services and tech platform businesses generated $579 million of revenue, up 61% year over year, and we also generated record fee-based revenue across all segments of $443 million, up 53% year over year. Turning now to our segment performance, starting with financial services. Financial services generated record revenue of over $1.5 billion in 2025, up 88% from the prior year. For the fourth quarter, net revenue was $457 million, up 78% year over year. Contribution profit was $231 million, up 2x from last year. And contribution margin was 51%, up from 45% last year. Net interest income for this segment was $208 million, up 30% year over year, which was primarily driven by growth in member deposits. Non-interest income grew 2.6x to $249 million for the quarter, which equates to nearly $1 billion in high-quality fee-based income on an annualized basis. Importantly, improved monetization continues its strong contribution to revenue growth. Annualized financial services revenue per product was $104 in the fourth quarter. That's up from $81 in the fourth quarter of 2024, a year-over-year increase of 29%, and we see continued upside as newer products mature. The successful expansion of our loan platform business was one of our greatest achievements in 2025, further diversifying our revenue and making our growth more durable. We've built this business into a powerhouse. In Q4, a loan platform business generated $194 million in adjusted net revenue, an annualized pace of $775 million, which is nearly 3x higher than the same period last year. And as we head into 2026, we continue to see strong demand from both existing and new partners. Beyond our loan platform business revenue, we continue to see healthy growth in interchange, up 66% year over year, driven by close to $22 billion in total annualized spend in the quarter across money and credit cards. Turning to our tech platform, which generated record revenue of over $450 million in 2025. For the fourth quarter, the tech platform business delivered net revenue of $122 million, up 19% year over year. Contribution profit was $48 million at a contribution margin of 39%. This includes the remaining revenue earned from a large client who fully transitioned off our platform prior to year-end. Turning to our lending segment. Lending generated record adjusted net revenue of over $1.8 billion in 2025, up 24% from the prior year. For the fourth quarter, adjusted net revenue was $486 million, up 15% from the same period last year. Contribution profit was $272 million, with a 54% contribution margin. These strong results were primarily driven by growth in net interest income, which increased 29% year over year to $445 million. During the quarter, we had record total loan originations of $10.5 billion, up 46% year over year. Personal loan originations were a record at $7.5 billion, of which $3.7 billion was originated on behalf of third parties through LPB. In total, personal loan originations were up 43% year over year. Student loan originations were $1.9 billion, up 38% from the same period last year. Home loan originations were a record $1.1 billion, a year-over-year increase of nearly 2x. Capital markets activity was very strong in the fourth quarter. We sold and transferred through our loan platform business $4.5 billion of personal and home loans. In terms of personal loans, we closed $100 million of sales in whole loan form at a blended execution of 106.5%. All deals had similar structures to other recent personal loan sales, with cash proceeds at or near par, and the majority of the premium consisting of contractual servicing fees that are capitalized. These sales included a small loss share provision that is above our base assumption of losses and immaterial relative to the exposure we would have otherwise had if we held on to the loans. Additionally, we sold $90 million of late-stage delinquent personal loans. By selling these loans, we're able to generate positive incremental value over time versus selling after they charge off, both from our improved recovery capabilities and by maintaining servicing. In terms of home loan sales, we closed $692 million at a blended execution of 102.3%. In addition to our loan sales, we executed a $463 million securitization of loans originated through the loan platform business. This channel provides our partners with meaningful liquidity to support their ongoing investment in the loan platform business. The transaction priced at an industry-leading cost of funds level with a weighted average spread of 101 basis points. Turning to credit performance. Our credit remains strong, performing in line with expectations and driving attractive returns across all loan types. Our personal loan borrowers have a weighted average income of $158,000 and a weighted average FICO score of 746, while our student loan borrowers have a weighted average income of $149,000 with a weighted average FICO score of 765. For personal loans, the annualized charge-off rate was 280 basis points, up 20 basis points from the third quarter. I would note that while this is up from last quarter, it is down slightly from the second quarter and down over 50 basis points from a year ago. In fact, this is our second best quarter since 2022. Importantly, the increase in our balance sheet charge-off rate is driven by mix rather than credit deterioration. In Q4, as a result of increased LTV activity, we retained fewer new loans on the balance sheet. This naturally increases the average age or seasoning of our personal loan portfolio held on the balance sheet. Adjusting for this seasoning, underlying credit trends actually improved quarter over quarter. Had we not sold any late-stage delinquencies, we estimate that including recoveries between 90 and 120 days delinquent, we would have had an all-in annualized net charge-off rate for personal loans of approximately 4.4% versus 4.2% last quarter. The on-balance sheet 90-day delinquency rate was 52 basis points, up 9 basis points from last quarter, also driven by portfolio seasoning. I would note that the delinquency rate is down year over year. For student loans, the annualized charge-off rate was 76 basis points, up slightly from 69 basis points in the prior quarter, driven primarily by seasonality, as well as the impact of a student loan repurchase that began in Q1 2025 and concluded during the fourth quarter. The on-balance sheet 90-day delinquency rate was 14 basis points, consistent with the prior quarter. The data continues to support our 7 to 8% net cumulative loss assumption for personal loans, in line with our underwriting tolerance, although we continue to trend below these levels. Our recent vintages originating from Q4 2022 to Q1 2025 have net cumulative losses of 4.55%, with 37% unpaid principal balance remaining. This is well below the 6.27% observed at the same point in time for the 2017 vintage, the last vintage that approached our 7 to 8% tolerance. The gap between the newer cohort curve and the 2017 cohort curve widened by 8 basis points during the fourth quarter. In fact, this gap has widened in each of the past 6 quarters since we began measurement. Additionally, looking at our Q1 2020 through Q3 2025 originations, 60% of principal has already been paid down, with 6.8% in net cumulative losses. Therefore, the life of loan losses on this entire cohort of loans to reach 8%, the charge-off rate on the remaining 40% of unpaid principal would need to be approximately 10%. This would be well above past levels at similar points of seasoning, further underscoring our confidence in achieving loss rates below our 8% tolerance. Turning to our fair value marks and key assumptions. As a reminder, we mark our loans at fair value each quarter, which considers a number of factors including the weighted average coupon, the constant default rate, the conditional prepayment rate, and the discount rate comprised of benchmark rates and spreads. At the end of the fourth quarter, our personal loans were marked at 105.7%, down 8 basis points from the prior quarter. This included an increase in the annual default rate, which was primarily driven by loan vintage seasoning, not changes to the individual loan loss assumptions, partially offset by a lower benchmark rate. At the end of the fourth quarter, our student loans were marked at 105.6%, down 8 basis points from the prior quarter, driven by minor changes in the average coupon and annual default rate. Turning to our balance sheet. In December, we raised $1.5 billion of new capital in the form of common equity. This was our second opportunistic raise of 2025, giving us great flexibility to pursue organic and inorganic growth opportunities. It also allowed us to further improve our funding base. Over the past 2 quarters, we fully paid down our warehouse lines, reducing our funding costs by an estimated $110 million on an annualized basis, fully mitigating the bottom line impact of of the additional shares. In the fourth quarter, including the $1.5 billion in new capital, total assets grew by $5.4 billion. This was driven by $3.1 billion of loan growth and approximately $1.7 billion of growth in cash equivalents, and investment securities. Total company-wide cash at quarter end was $5.4 billion. On the liability side, total deposits grew by $4.6 billion to $37.5 billion, primarily driven by growth in member deposits. Our net interest margin was 5.72% for the quarter, down 12 basis points sequentially. This included a 30 basis point decrease in average asset yields as we saw a modest mix shift from personal loans to home and student loans, partially offset by a 15 basis point decrease in cost of funds. We continue to expect a healthy net interest margin above 5% for the foreseeable future. In terms of our regulatory capital ratios, we are very well capitalized. Our total capital ratio of 22.9% at quarter end is well above the regulatory minimum of 10.5%, as well as our additional internal stress buffer. Tangible book value grew $4 billion year over year to $8.9 billion, including the benefit from the new capital raise. And tangible book value per share at quarter end is $7.01, up from $4.47 a year ago, a 57% increase. Let me finish by providing our outlook for 2026 and the medium term, starting with the macro assumptions that underpin our financial guide. In line with market expectations, our 2026 assumptions are as follows. An interest rate outlook consistent with the Fed funds futures and 2 rate cuts to get us to a 3.0 to 3.25% exit rate in 2026. Real GDP growth of approximately 2.5% and an unemployment rate in the 4.5 to 5% range. Now for our specific guidance. For the full year 2026, we expect to increase total members by at least 30% year over year. We expect adjusted net revenue of approximately $4.655 billion, which equates to year-over-year growth of approximately 30%. We expect adjusted EBITDA of approximately $1.6 billion, which equates to an EBITDA margin of approximately 34%. We expect adjusted net income to be approximately $825 million, which equates to a margin of approximately 18%. We expect adjusted EPS to be approximately 60 cents per share. The guidance assumes a mid-teens tax rate, which we currently believe to be our effective tax rate in 2026. For the first quarter of 2026, we expect to deliver adjusted net revenue of approximately $1.04 billion, which is a 35% year-over-year increase compared to 33% in the same period last year. Adjusted EBITDA of approximately $300 million, which equates to a margin of 29% versus 27% in the same period last year. Adjusted net income of approximately $160 million, which equates to a margin of 15% versus 9% in the same period last year. And adjusted EPS of approximately 12 cents, 2 times the 6 cents delivered in the same period last year. It's important to note that each year we have seasonal payroll taxes during the first 2 quarters of the year, and we plan to accelerate marketing expenses in the first half of 2026 relative to Q4 2025. Overall, 2025 has been a remarkable year for SoFi. We are proud of the strong results we delivered and are excited to build on this momentum in the year ahead. Looking beyond 2026, given our differentiated model, the strength of our balance sheet, and the tremendous opportunities that exist across our business and in newer areas, we expect to deliver compounded annual adjusted net revenue growth of at least 30% from 2025 to 2028. Additionally, we expect to deliver compounded annual adjusted earnings per share growth of 38 to 42% from 2025 to 2028. Let's now begin the Q&A.
At this time, I would like to remind everyone, in order to ask a question, press star and the number 1 on your telephone keypad. Please keep in mind we'll take only 1 question per person at a time, and please rejoin the queue for any additional questions. First question today comes from John Hecht at Jefferies. John, please go ahead. Your line is open.
He might hit $40 price target, this guy.
Morning, guys. Congratulations on the good momentum. I guess my question is, you guys gave some good consolidated guidance. Maybe can you break some of those details out at the segment level?
Yeah, they didn't do that.
Sure, I can take that one, John. So overall, like we've said in the past, given that we're right in the middle of two super cycles with blockchain and crypto and AI, and the fact that we have significant capital cushion in any scenario that we could have possibly imagined, that makes us extremely excited about the outlook for our business, both in the immediate and the longer term. In terms of our 2026 outlook, we expect continued very strong revenue growth of roughly 30% year over year. As it relates to the segments, for financial services, we expect revenue growth of 40% or more. For lending, we expect revenue to grow approximately 23% year over year. And then for tech platform, normalized for the transition of a large client, we expect revenue growth of approximately 20%. And then
Dang.
for our corporate segment, revenue should generally be in line with what we saw in 2025 on a dollar basis. As we look forward out to the medium term, we're expecting at least 30% annual revenue growth compounded between 2025 and 2028, and 38 to 42% annual compounded EPS growth between 2025 and 2028. From a segment perspective, we expect to see continued momentum across all segments. And given the investments that we've made to date, we see the opportunity to accelerate growth in 2027 and 28 across a number of products that are just starting to scale, including our crypto business, our brokerage business, home loans, and student loans, given the rate environment. So overall, really optimistic about the outlook, given everything ahead of us.
The next question comes from Andrew Jeffrey at William Blair. Andrew, please go ahead. Your line is open.
Hi, good morning. Great to see the momentum in the business. Anthony, you've talked about driving awareness, and I think you mentioned today on the call the opportunity for refinancing at $1 trillion. It looks like perhaps that messaging hit an inflection point this quarter, and you mentioned some of the celebrity partnerships. Can you elaborate a little bit on the acceleration in KPI growth, whether it's sustainable, whether you think this is sort of the tipping point at which consumers say, hey, look, just simply SoFi got a better answer than traditional banks? Can we sort of declare that we've reached that point in your business model?
Thank you for the question, Andrew. We are at 9.6% unaided brand awareness. We would love our unaided brand awareness to continue to grow, to get into the mid-20s, which would, when we get there, likely put us at the top 10 financial institution. When I joined, our unaided brand awareness was around 2%. And for those that aren't familiar with that measure, unaided brand awareness is asked in the following way. When you're thinking about a financial services product, please name 3 companies you would consider. So it doesn't ask about student loans. It doesn't ask about personal loans or any of the other products that we have. It just asks that generic question. The ability to move it from 2% to 9.6% is really, really challenging in the time period that we have. The largest banks in our country, the most well-known banks in our country, the most trusted banks in our country, they've been doing it for centuries. And some of them less than centuries, but a very, very long time. So our team has really crushed it in leveraging a combination of branded advertising and performance-based advertising. And we absolutely partner with big, well-known stars, big, well-known entities like SoFi Stadium and innovative things like SoFi TGL. We'll continue to look for those opportunities. But I'm more than confident than ever that we've reached the point where I can go someplace and someone will say, oh, do you work for SoFi? I have a SoFi account. That wasn't happening 8 years ago. It happens all the time now. And so one of our products in 2026 is trying to build product quality to such an extent that we drive virality and our customer acquisition costs go down meaningfully because of word of mouth, because of referrals. We're doing incredibly well now as it relates to our return on marketing spend. You can see that in our margins. We delivered more than our long-term margin originally stated when we went public, which we've now increased directionally. So we do believe we can spend money and get a return on it. We have the analytics of that nailed down. That's what's allowing us to drive more than 30% member growth consistently over the last 8 years and coupling it with product growth. The 40% cross-buy number that is a number that's up almost 10% versus a year ago. And that's not easy to do when you're growing the business so quickly on a new member basis. So we're really hitting on all cylinders. We feel like we have the right marketing formula, but we're not going to rest on our laurels. I really want us to get that escape velocity where the amount that we spend becomes more and more efficient. And this is before implementing AI. It's really about product quality and awareness. and that filtering down to greater productivity of our marketing dollars.
The next question comes from Dan Dolev at Mizuho. Dan, please go ahead. Your line is open.
Hey guys, great quarter and epic medium-term guidance. Congratulations. Wanted to ask you, maybe Chris, about LPB in terms of how do you think about origination specifically, and how much should be allocated to LPB versus the other stuff? Thank you.
Sure, thanks, Dan. So step back and talk a little bit about our origination outlook for the entire business. Overall, we had record originations in 2025, which were fueled by strong borrower demand across each and every one of our asset classes. What we're seeing so far in 2026 is that demand remains extremely robust, and we have more flexibility than we've ever had as a company entering 2026. We expect that total originations for the company will be up strongly year over year, and we have the luxury of choosing to drive capital-light fee-based revenue through our strong capital market pipeline, particularly in the loan platform business, as you mentioned, where we just signed a new partner, and we have several partners at final term sheet stages. Or B, we have the opportunity to keep these higher returning assets on our balance sheet and putting our newly raised capital to work. Ultimately, how we're going to allocate those assets is going to be determined by our overarching goals of serving our members and driving durable growth to maximize returns for our shareholders in the long run. Given that we have significantly scaled our loan platform business to over $14.5 billion in annualized volume, we've diversified our revenue to 44% in fees, and we have the excess capital. We have phenomenal optionality today. Holding these loans on our balance sheet results in the highest total return for each and every one of our loans, while transferring them through the loan platform business carries no risk and results in immediate revenue and cash, as well as attractive returns for us. So we're really in an enviable position of choosing between two great options, and we're going to balance them accordingly.
Nice.
The next question comes from Kyle Peterson at Needham & Co. Kyle, please go ahead. Your line is open.
Great. Good morning. Thanks, guys, and nice results. Wanted to touch on the deposit growth this quarter. It was really impressive and great to see. So I guess, is this still largely coming from member deposits? And then could you guys give us a refresher on what the recent downward beta has been? That'd be really helpful. Thank you.
So a couple things on deposits. I've said since we opened the bank that we have a competitive advantage in being able to offer our members a better value proposition than anyone else on something like SoFi Money. Combination of a high APY, reward opportunities, as well as other services that we provide, like free certified financial planning, et cetera. I think as rates continue to go down, our advantage will make itself more clear. Everyone that we compete against in that top quartile, they kind of fall into two buckets. One, they're a newer bank that actually does lending, and they have an ability to provide a rate above Fed funds, but they have a deposit base that's so big they can't be too aggressive because they'll reprice their entire deposit base. And that's a structural issue that we fundamentally don't have. Second is people that are not actual banks that are using sponsor banks, and they can only get Fed funds plus 20 or 30 basis points. Because we have such a large and profitable lending business, we can use those profit pools to give a rate that's unmatched by other people. We haven't had to do that yet because we've had such great demand for our product, and that's driven the deposits. And I think we'll continue to show that we can be in the top quartile APY and achieve the level of deposit funding that we want, and it remains relatively sticky. The bulk of our deposits, almost 97%, are direct deposit customers, and that is high quality primary account relationships, and that's what we're aimed at.
Yep. And the only other thing I would add to Anthony's comments, because you asked about it, is the downward beta. Since we launched the bank, we've been at roughly a 60 to 70% beta, and we would expect that to stay consistent going forward.
The next question comes from Reggie Smith at JP Morgan. Reggie, please go ahead. Your line is open.
Congrats on the quarter and strong guidance. Real quick for me, I guess it sounded like, Anthony, you sounded very, bullish on some of the new products. I'm thinking about, the crypto, I'm thinking about stablecoin, I'm thinking about the smart card. And I'm curious, do you think that the innovation that we're seeing on the fintech side could spur more interest and demand from your tech platform customers? Now, historically, I think you guys have led with kind of card processing and things like that. Good stuff, not as interesting as some of the newer things that are kind of coming down the pipe. Maybe you talk a little bit about that and if this could signal or catalyze like a change in adoption and growth in tech platform.
Sure. The tech platform business is definitely benefiting from, let me say, it could benefit from the areas that you just mentioned. So, a year ago, the amount of demand or interest that we had in blockchain and stable coins and wallets, et cetera, for tech platform partners was really non-existent. But since the administration changed and the OCC came out with the permissibility of crypto and blockchain among banks, the amount of interest in leveraging the tech platform services has really increased quite meaningfully. We don't have anything to announce yet. We're in tons of dialogues with different types of companies. There are companies that are launching a debit card type of product in LATAM countries that's backed 100% by stablecoins. It's not backed by fiat dollars at all. And so there's a fair amount of that. There's also a fair amount of program managers for that type of product. And then, in the US, I think there's less activity from financial institutions for those services. It's more in the LATAM countries, but we do anticipate it'll spill over to the US, and some of the international companies will look to the US because of it's a more inviting environment from an administrative standpoint. I think the Clarity Act is very important because it will establish into law the permissibility of crypto and blockchain by banks. Right now, we're all relying on the OCC's interpretive letters, and it'd be much better if it was locked into law, especially if the administration changes in a couple of years. But I'd say the outlook and opportunities that crypto provides for the tech platform, as well as our own business, are pretty enormous, and I couldn't be more excited about it. It adds a whole nother dimension of growth for us, but it also drives a whole nother sort of lens of innovation across all of our products. And when you have as many products that we have, and you have an entirely new technology platform at a lower cost, at faster speed, and it's safer, it can fundamentally change everything that we do.
The next question comes from Kyle Joseph from Stephens. Kyle, please go ahead. Your line is open.
Hey, good morning, guys. Thanks for taking my questions. On the third quarter call, we talked a lot about capital markets, and I think you guys referenced a flight to quality from investors. Just kind of looking to get an update there. Obviously sentiments change, but yeah, a little bit of a capital markets update and any implications on the competitive front on the personal loan side of things. Thanks.
Yep. Sure. Thanks, Seth. So overall capital markets activity and demand remains extremely robust. We continue to see that flight to quality that we mentioned during the Q3 call. We just had a phenomenal quarter in our loan platform business, transferring $3.7 billion of loans on behalf of others. We just signed a new partner this week for 2026. LPV, and we have several other partners who are in final term sheet stages. So overall demand couldn't be better from an investor perspective. As it relates to personal loan competition, we just had record originations of $7.5 billion in the quarter. We're seeing that trend persist into 2026. So all else equal, we feel great both from a capital markets perspective as well as a borrower demand perspective. In terms of how we're thinking about just as it relates to personal loans and growth in the balance sheet, we are expecting to grow the balance sheet in the double-digit billions, which is in line with what we did in 2025. We're seeing great momentum so far here in early 2026. And we expect that to persist throughout the year.
The next question comes from Peter Christensen from Citigroup. Peter, please go ahead.
Thank you. Good morning. Congrats on the great momentum here. Anthony, I'm curious your perspective. There's been some areas within private credit which have seen some sentiment change more recently. Doesn't seem like it's too much in the direct consumer lending portion of that area. I'm just curious from your perspective, what you're seeing from some of your private credit partners and demand flows there. Thank you.
Yeah, what I'd say is the attractiveness of our assets and our loans is tied to the returns that they have, and we obviously are focused on a prime customer in the business that we're putting on our balance sheet, and mostly what we're doing with partners. And the key is to make sure we're delivering our target return against that. We've been able to manage the performance of prepayments, the performance of defaults, and the performance of interest rates and our cost of funding to deliver great value for our partners. And as long as we keep doing that, they'll continue to be in more demand than supply. With the amount of capital we have on our balance sheet now, I think you could see our growth in originations and revenue and lending start to close a little bit. In the fourth quarter, our originations were up 40% year over year, but our lending revenue was up 15%. And so we're really servicing our partners in a great way, but we could keep more of that production if we so chose, especially given our confidence in our returns.
The next question comes from Moshe Orenbuch from TD Securities. Your line is now open. Please go ahead.
Great, thanks. Chris, you talked a little bit about the allocation between the loan platform business and the core, and the balance sheet for your lending segment. Could you just kind of tell us what the contribution from the loan platform business you're expecting in the 26?
Sure. We aren't guiding specifically to origination volumes or LPV volumes for 2026, but what I would say is, we just exited 2025 at a $3.65 billion quarter, annualizes to about $14.5 billion of originations. We feel good about that level heading into 2026. We have sufficient demand from borrowers. Like I said, the new one we just signed up. We have all of our existing partners as well have extended their contracts and often upsized their commitments in periods. So there's sufficient demand from capital markets participants in our LPB program. But like we said, we have a very robust balance sheet, high capital ratios, and we're going to balance the allocation between the two to maximize shareholder value.
The next question comes from William Nance at Goldman Sachs. William, please go ahead. Your line is open.
Hey, thank you for taking the question. I just a lot of good questions already on the call. I just wanted to clarify the comment on the expectation for segment growth rate on the tech platform business. I think you mentioned it was pro forma for the large customer migration. Is there any way you could give us a baseline or just a jumping off point there as we think about rolling forward the next quarter? And then I think separately, I think that customer had spoken about like a fairly large termination fee that they would have to recognize. Could you just confirm if that was in this quarter, or if you've already recognized that, or just how that's being treated? I appreciate the detail in the questions here.
Yeah, sure. So as it relates to the outlook that Chris mentioned, he said 20% growth for the tech platform, apples to apples without the large customer in both years. We're not going to give you more granularity than that. Our outlook assumes no revenue in 2026 from that large customer. The deal with that large customer ended. The revenue also ended in Q4, and the revenue in the quarter from that large customer was part of our contract, and it was equal to the average of the revenue in the last 6 quarters. So I think people will characterize that revenue in a lot of different ways, but the simplistic way to look at it is the revenue was tied to the ending of the contract, or revenue came in at a level that was equal to the average of the last 6 quarters. Chris, I don't know if you'd add anything to that.
No, that's spot on.
The next question comes from Jill Shea from UBS. Jill, please go ahead.
Good morning. Thanks so much for taking the question. I just wanted to touch on profitability. You've posted some really nice progress on ROTCE. I think you posted 9% in the fourth quarter. And clearly there's a lot of momentum in the business, and you've been leaning into capital-light businesses and growing the fee income mix. I'm just wondering if you could touch on the ROE of the business over a longer term horizon. I think you've mentioned 20 to 30% in the past. Has that changed at all? Is the timing of the path changed at all? Perhaps you can just touch on the overall profitability of the business that you're building.
So I would say this: we believe we're building a business that will have superior return on equity and return on tangible equity. We still believe it's in the 20 to 30% range. We are not going to underinvest in the business to get to that number while we're growing at the rate that we're growing. You should expect that we're going to continue to manage the business to a 30% incremental EBITDA margin, and as opposed to trying to drive it higher to maximize the ROE in the near term. Ultimately, if you see us growing less than 15% in revenue, you're going to see meaningful margin expansion and us driving to our long-term ROE. Between there and here, which hopefully I'm long gone by the time we get down to 15% from not on the earth any longer, because I expect to be here for the rest of time, unless for some reason someone asks me to leave. I hope we never see 15%. But we would be under-delivering on the opportunity in front of us if we didn't keep investing. So we're not just dropping it, all into investment. We're dropping some to the bottom line, at least 30 cents of every incremental dollar in an annual period. And that will give you a good indication of how we can drive returns over the long term. But the growth rates of over 30% that are in front of us this year at the scale that we're at just says we're just getting started. So we don't want to underinvest in that. Chris, you got anything else?
Guys, they
The
killed
final
it.
question we have time for today comes from Devin Ryan at Citizens Financial Group. Devin, please go ahead.
Devin.
Hey, this is Noah Katz on for Devin. Thank you for the question. With over $3 billion raised in the back half of the year, you're entering 2026 with a substantially stronger capital position. How should we think about capital allocation towards balance sheet growth versus other strategic opportunities? And can you speak on your appetite for M&A? And also on M&A, please remind us of the hurdles and considerations there. Thank you.
Yeah, so in terms of how we're thinking about capital allocation, like you said, we have 23% capital ratios today. It's over 1,000 basis points higher than our regulatory minimum and meaningfully higher than the regulatory minimum plus our internal stress buffer. So we feel great about the position that we're in. We're in that enviable position where we can grow and put more assets on the balance sheet. These are very good returning assets that we're underwriting today, and we feel good about that, as well as the LPB partnerships, as I've mentioned a few times during this call. I'll let Anthony touch on anything as it relates to M&A.
There's a lot of opportunities out there. I would say more than we've ever seen in our 8 years here. But I'd also say the bar is really high for us. And when I say really high, we've looked at dozens and dozens of things, some of which were for sale, some of which were interesting to us. What we're prioritizing are things that can accelerate our growth versus the time it would take to build it ourselves. So one area we're very interested in is technology platform capabilities. And so wallets as a custody as a service, stablecoin as a service, being able to provide a market exchange for fiat and for different types of stablecoins. Our pay product, SoFi Pay, we launched in September. It is currently using Bitcoin and the Lightning Network to transport fiat dollars from the U.S. to fiat dollars in over 30 countries internationally. And so is there a way for us to accelerate SoFi Pay's international expansion through a technology platform type of acquisition or infrastructure? We're also very interested in international countries and the licenses some small companies could have. In addition to that, in technology platform, we don't have revolving credit card processing and issuing. It's something we can build ourselves, but if there's a technology that's not that expensive and we don't have to pay for a business, we may do that and leverage our technology platform and core plus their processing to enter the revolving credit technology platform services space. There are some horizontal things that we've looked at, but nothing of interest. As you know, we've talked about building big business banking, and we looked at some SMB platforms to see if they would accelerate our opportunity there. The fact of the matter is they don't, and we're likely going to build that ourselves. Big business banking, that is, which we have seen really strong positive response from the marketplace as it relates to the need of these services to be a bank that can do both fiat and crypto. So we feel really good about having optionality on our balance sheet. I don't feel good about finding stuff at the price that we want. So far, what I'd say is it's all going to be organic. But if something presents itself in the area that I mentioned at the right price versus doing it internally, we would act on that. But the bar is really high. I know that was our last question, so I just want to wrap the call up. First, thank you all for joining. 2025 was an exceptional year by any measure. The more I went through our results in preparation for earnings day, the more I was able to truly grasp how exceptional the fourth quarter and full year are, looking through any lens, and how far we've come over the last 8 years. I could not be more proud of our team for building a diverse, resilient business that is impacting our members in an unbelievable way, and that positions us to overcome whatever obstacles are thrown our way. All of that said, I think it's an understatement to say that we're just getting started, and I am more excited about what lies ahead than I have ever been at SoFi. You can rest assured that we will move faster than we ever have, we will work smarter than we ever have, and we will be more resilient than we ever have to capture the massive opportunity in front of us. Fresh horses we ride, and look forward to seeing you next quarter.
Goodbye.
That concludes today's conference call. You may now disconnect your lines.
All right, guys, that's it. All right. Well, we didn't get the 55-cent CPS, thank God. We didn't want the 60, but we got the 60. But we know what SoFi is going for. They're going for 75 cents. Right? Not bad at all. So let's take a look and see what 75 cents truly means with the new dilution. That's what we got to be looking at, okay? We need to find out if they come out at 75, how much money are they going to make? So right now, we know that SoFi has about 1.35 billion in outstanding shares. So we'll just pump those numbers up a little bit to 1.375 billion for dilution. Like small dilution for like what is it called? Stock-based compensation and stuff like that. So take a look, guys. If we get that, we break $1 billion net income. We break 1 billion. Look at that, guys. You see that right there? Look at that. It's the outstanding share count. If we guide for 75, you're making $1 billion in profit. SoFi's market cap is 31 billion right now. You're trading at a 31 times PE for a company potentially going to grow their top line 40% this year. Come on, guys. There's companies trading at 300, 400, 500 times PEs that are growing at the same rate, 30, 35%, guys. You're going to get your $1 billion profit this year. Not revenue. We're going to get the $1 billion profit. Okay, it's coming. I mean, you're getting bottom line growth, potentially 90%, and top line at 40. I think 60 was the right choice. Now that I'm seeing that they beat the analyst, that's the headline. Beat analyst, because it was 55. It was 55. They didn't have to put out the 65. They didn't need it because they beat Wall Street. They beat analysts. So even though I was, BSing on Twitter, complaining for 2 days straight, you guys all saw it. They better not put up 55 or 60. I wanted the number 65. This quarter gives them the stamp for S&P 500. No mistakes. They didn't have to put the 65 EPS out there, put pressure on their back. They did this quarter for S&P 500 approval. Okay, that's all this was about. This company is fully eligible. The market cap's going higher. Profits are going higher. They have all the requirements. They're the largest financial service company out of all 15 companies that I'm tracking right now. They're the largest. I don't know what else to say. These guys have a high probability now of getting inside of March. March, you got to look at it, is always a big quarter for the S&P 500. They usually let in about 4 companies. And take a look, guys, right here. You got your top 15 right here. Take a look. That's your top 15. SoFi, for its industry financials, is the largest. So they're not the largest by market cap, but whenever the S&P 500 goes to snag a financial, they're probably going to go after the biggest company. And SoFi is at the largest market cap, 31 billion. So you're trading at a 31 times forward PE if we get the guidance that we're looking for, and a potential 40% growth rate. So, of course, I can tell you the first three companies that are going to get in are Marvel and Vertiv. Marvel and Vertiv are going to get in first because they're just so large. And the third, I don't know about the third or fourth, but yeah, Marvel and Vertiv are going to get in first because they're just so large. But yeah, guys, it's we're probably at like, I don't know, 40% right now for Q1, probably 40%. There's a high probability if they let in 4 companies, dude, this quarter is exactly what we needed for the S&P 5 committee to see. Our balance sheet, guys, I mean, look at the balance sheet. Nobody's talking about the debt right now. Nobody's talking about the debt or the offering that we did, because look at this, guys. It went from 3.2 billion cash to 4.9 billion in cash, 2.7 billion debt to 1.8 billion in debt. Cash up massively, debt down. This is a fortress, just like Anthony noticed that on the call. I said gold standard. He said fortress. When I was reading through the numbers, I had to post this. Guys, this is S&P 500 balance sheet right here, okay? And a company growing 40%. Obviously, we know SoFi sandbags. They guide at 30, which beat analysts, but I think they're going to grow 40% this year and put $1 billion in profit. So, guys, if we got to $32 stock price off our Q3 quarter, if we got to $32 off the last quarter, $32, should be a lot higher than that with this quarter in guidance. This company is looking like a monster, and it's actually priced cheap right now. I want to see the stock hit the offering price, $27. I want to see it hit that pretty quick, maybe in the next week. But that's a wrap, guys. We are out of here. So great quarter, triple beat, S&P 500's on the way. They're doing what they need to do. They execute it, and hope you guys have a great day. Hope you guys enjoyed the live stream. Catch you later.